All right, well, good afternoon, everyone. This is Scott Thompson, and we are here for our active trading options with the focus on vertical spread session here. It's about 3 p.m. Eastern Time on the 13th, actually 14th of March, and great to be here with you today. Our agenda for today is we're going to be going over how to manage a long vertical that we put on a few weeks ago. We're also going to talk about managing a short put vertical. Yesterday we looked at managing some losing trades in our managing an option portfolio class, and today I thought we'd focus on managing some winning trades and talk about some strategies to get out of those trades or set orders that you can get out of those trades. We also want to go over, a few weeks ago I did a session on a Wednesday evening webcast on protecting the whole portfolio using vertical spreads on an index, and so I thought what we would do today is go ahead and go back over some of those concepts, go through a process of what's called beta weighting your portfolio, and then talk about some strategies on how to manage the risk of the market pulling back or going down against some bullish types of positions. And so we'll talk about that today as well. As always, remind everyone that our presentation is for educational purposes today, not a recommendation or endorsement of any particular investment or investment strategy. Options are not suitable for all investors. A special risk inherent to option trading may expose investors to potentially rapid and substantial losses. If you do want to trade options, get a hold of that characteristics and risks of standardized options. Also remember that spreads, straddles, and other multiple leg option strategies entail substantial transaction costs, and those can impact your potential return. Also be aware that in order to demonstrate the functionality of the platform, we need to use actual symbols. None of those symbols are recommendations. Any investment decision you make in your self-directed account is solely your responsibility. Past performance does not indicate or guarantee future success. And that is regarding any security or strategy. Be aware also that investing involves risk, including loss of principal. Be aware of how your delta, gamma, vega, and theta Greeks will affect your option trades. Paper money is a trading platform software program for educational purposes. Any successful virtual trading does not guarantee successful real money investing later on. There's no soliciting, no photography, no rebroadcasting without the prior written consent of TD Ameritrade. And another thing too is we've got a lot of great upcoming events. If you're going to be in the Washington, D.C. area this weekend at the Fairview Park Marriott, Ben Watson and I will be doing an investing fundamentals course. If you feel like you're fairly new to investing or want to polish up on some of your investing fundamentals, also if you want to learn how to use more of the TD Ameritrade site for doing some searches and things like that, let me show you a great place to go on the tdameritrade.com website. If you go to the Education Events tab, this page will come up, and you'll see basically the classes that are coming up for the next little while. Tonight, I'm doing using long calls as a stock replacement strategy, so love to see you here tonight. That's at 8 p.m. Eastern Time. The best place to go to find the live events is come up, click on Active Trader up here, and then you can kind of see all the cities we're going to over the next several weeks. Washington, D.C. this week, New York for Strategies for Growth. If you want to learn more about technical analysis and options and things like that, go to the Strategies for Growth. We'll be in Seattle, Los Angeles, Phoenix, and Seattle over the next several weeks. And so great resource up here to take a look on the Active Trader page. And again, that's on the tdameritrade.com website under the Education Events tab. So let's take a look here at our open positions in our account. The long vertical that I wanted to go over was Amazon. We bought a long call vertical on Amazon a few weeks ago, really not too long ago, and we paid $1.25 for that particular option trade instead of, say, $4,700 for a long call. Now, the trade-off, of course, is that if the stock goes up the direction you're forecasting and it goes up there in a big way, you could have a max gain on your vertical, which would have been the difference between our strike prices here, $15.25 and $15.22.50. That's a $2.50 wide spread, giving us a chance to make a maximum profit of $1.25. So that's 100% return on the investment. Now, we only did 7 contracts there to control our risk. We were risking about $1,000 is all on that particular position. And the management part that I want to talk about is when you're doing a long call vertical or any risk defined or capped type of trade, whether it's like a naked put that has a capped gain or a covered call that has a capped gain on it, where you cannot make any more than the premium collected, or in this case we have a long vertical that started off as a debit spread, and this also has a capped or a maximum profit on it. And one of the really common ways to manage a winning trade is to take about 80% plus of the maximum gain. So I wanted to show you how to calculate that on a long vertical. It's a little bit different than you do it on a short vertical. And then we'll talk about managing our Oracle short put vertical trade that we did a few weeks ago as well. You can kind of see that's trading really at zero, has 2 days left till expiration. And there's a special circumstance that we want to talk about here on our Oracle position when it gets down into these types of numbers, of ways that you have to manage it generally because of a certain situation that's going on with the bid and ask price. All right, so we're over here, and let's calculate now the maximum gain first on this Amazon trade. So the way that you do that is you take the difference between your strikes. Now this is a long call vertical again. You take the difference between these strikes. So 25 minus 22.50 is $2.50, and then you subtract the debit. So if we take 250 divided or subtract 125 from 250, what do we get? 125. So $1.25 would be our maximum profit, and if you wanted to get out, say with 80% of that maximum, you would take $1.25 times 0.8, and you'd want to try to make now at least $1 on that particular trade. Okay, so in order to get $1 gain out of this trade, and if you're trying to figure out your exit price, you take that $8 and add it to your original purchase. So if we took $1 and added it to our $1.25, that would be an exit price of $2.25. Now, I've been watching this mark price on this particular spread over the last about 15 minutes or so, and I saw it quote, now imagine this, at $2.65, and that's a little unusual because this value should be no higher than $2.50. So sometimes when you get these deep in the money options, the bid and ask spread get pretty wide, meaning that the ask price is several dollars away sometimes from the bid price, and so you get some screwy quotes sometimes, and so sometimes these in the money verticals will actually quote a mark price higher than what they really should be. Now that doesn't mean you can get filled at those prices, but occasionally you will see that, and I did see this quote at $2.65 a little earlier today. You can see right now it's quoting at $1.95, and again, if we try to get 80% of our maximum profit, the advantage of doing that earlier than later is that you get to use that capital for something else. So let's go through that calculation again and then set up an order, and you can kind of watch this marked price bounce around while we're talking here. But the process again is take the width of your spread, the difference between your two strikes. So we have 15.2250 and we have 15.25. So the distance here is $2.50. To get the max gain, the stock would just have to be above 15.25, and you can see here that it's $70 in the money. So there's a high likelihood that it will stay that way over the next 23 days, perhaps, but this is a lot of time for the market to correct or for this stock to go down, and this is one of the reasons that vertical traders like to get out of their trades when they can get that 80%, is so they don't have to hold on till the very end of expiration to get the full maximum profit. So again, the calculation is the difference between the strikes and subtract your debit, or the cost of the trade. So we have $2.50 minus $1.25, and that gives us $1.25 maximum potential profit. Multiply that number by 0.8, or 80%. I'm just doing it on my calculator here, and that gives us $1. So we want to try to make $1 on this trade, essentially, is what that means. And so we're trying to get out of this trade at $2.25, and you just saw that quote at $2.32. It's at $2.20 right now, and so we just create an order to get out. So let's do that. Right click, create a closing order. It's quoting right now right where we want to get out, so we'll just leave it a limit order at that price, make it good till canceled, and we're going to move that up to $2.25 because that's kind of the 80%, and then we're going to send this order off. Now you can kind of see this mid-nat spread here. See how wide that is? We're quoting at 232. The natural's over here at 15. Let's just look at the option chain itself and see here in the 6 April, we can kind of see where this is coming from. Look at these spreads. And this is pretty common when the stock goes deep in the money like this. We have a $2.40 spread between the bid and ask, and then we have a $2.60 or $2.26, what's that, 35-cent spread. So pretty wide spreads, and this is why we're getting this mid-natural thing that looks so crazy over here. Now, we could set the order up at 230, 250, wherever you want to put it, but we're going to leave it at 225. Let's see if we can get filled sometime during our class today. We're going to hit confirm and send, and then review the order and say to ourselves, all right, I want to sell those contracts. The max profit and max loss at this point really don't make a lot of sense because it doesn't look at this as an existing position. These numbers reflect this as if it was a brand new position. So, you know, I kind of ignore these max profit and max loss numbers on this closing trade because it doesn't really realize that we have the open trade there. Remember that you have your transaction costs, and we're just going to send this order off and leave that as a working order. And that'll probably fill, hopefully, while we're in the class today. If it doesn't, we've made it a good till canceled order to realize the gain of 80% of that maximum potential profit there. Okay, so again, you can kind of see the quotes at $1.92. We need this to quote again up in that 225, 230, 235 range, and then we could get filled on that order. And again, it's over here. We can see the buy and sell, and we do have it good till canceled in case it doesn't fill today. All right. Now, oftentimes these long call verticals, even though we're deep in the money, because there is so much time value left in those options with 23 days left, sometimes it is a little bit challenging to get filled at those levels. Okay. But we'll leave that order in there, see if it fills while we're in the class today. All right, the other one I wanted to talk about was Oracle. Okay, Oracle, we did a long or short put vertical here over a month ago. We did this on the 31st of January, forecasting an upward movement, or at least some sideways movement where it doesn't go down too much. The stock's trading at 52.38 right there. And we're in a short put vertical at 50 on the short side and 48 on the long side. Anything above 50 is going to be a maximum profit, and here we have 2 days left until expiration. And so now we kind of have an interesting scenario. We have this quote that's showing 1.5 pennies on the mark price for each one of these options. Now, usually when you see this type of mark price here, you're going to see a zero bid. And that's important because if it has a zero bid, that means nobody really wants to buy that. We just got filled here on our Amazon trade at the 225, so we just realized you know, that 80% of maximum gain on that. We're out of that trade on Amazon and freed up that capital to do something else. But here on Oracle, again, we have a 50 to 48 $2 wide spread. We sold it for 46 cents. That's about a 25-26% return on risk, I believe, somewhere in that neighborhood. The options are quoting at really low prices. So let's go look at these individual strike prices, and I just want to talk about how to get out of this. The very first time I ran into this situation, I thought, oh great, I've got almost a max gain. I'll try to close the trade down, and it would never fill the order. So I don't know if you've run into that before where you've tried to get out of your verticals and you're even asking less than the current quote, and it just doesn't fill. Well, part of the reason for that oftentimes is because your long position has a zero bid on the option chain. So let's go look at it here. Let's go to the trade page. Well, actually, let's do this. Let's do a right click, create the closing order for the whole vertical. We're getting a quote of 1 penny, and let's look at our position. Okay, I'm going to shrink this section down a little bit. Okay, so here's our option chain. If we scroll down and we find the 40 strike, we can see the little flags over here for our position. We have a selling order, or sorry, a short position that has zero bid, and we have a long position that has zero bid. And so if we tried to sell this or close this spread down, what is it exactly we're doing? Well, we're trying to sell our long position. Well, if there's a zero bid, nobody really out there is bidding on to buy this from anybody else. So if there's a zero bid, then it's often almost impossible to get this order filled as a vertical because the long component that we own, the long put at 48, nobody wants to buy it. There's no bid price. Now, we can generally buy back the short position if there's an ask. And so, if we wanted to just close the short position, we could buy that back for about 3 cents. And this is what's kind of cool about Thinkorswim is if the ask price or if the transaction on a single closing order for a short position, generally if that's less than 5 cents, depending on the type of account you have, there may not be any commission on that. So you have to check with the broker to see how your account's set up for exactly that transaction. But you can see here the vertical may be hard to close because there's that 0 bid on the long position, but we could certainly close the trade down, remove the obligation of the trade which exists here with the short $50 put, and just buy the short put back. And that's what I wanted to talk about here today on the Oracle trade, is when you see these kind of really low quotes over here, most of the time you'll probably have to close down just the short position because nobody wants to buy the long. And the way that you do that, you right click on the symbol, create a closing order, and you get 3 choices. You'll get a chance to close the whole vertical, or you can sell the long, or you can buy back the short. And so we're just going to click an order in here to buy back the short position, which will release the obligation associated with the trade, and that creates an order here for 3 cents. You could certainly try to split the difference, go with the 1.5 or 1-2 cent here and see if you get filled. This is below 5 cents, so when we hit confirm and send, normally it will have a transaction cost associated with it here, but again, check with your broker to see how they handle a buyback or a closing order of a short single position at less than 5 cents. So we're going to go ahead and send this order off, see if we can get filled. We got filled immediately here. And so now what do we have? Well, we just have the long put left here that's going to be showing a horrible loss. So just be prepared for that when you go back to your monitor tab. Now it looks like we have a P&L open of $592. This number does not remember that we just took a nice profit on the short put, and so it's just showing the leftover result of this trade that was bought for 38 cents that essentially is worth 1 penny now. And so that's a 37-cent loss, $37 a contract times 16, and that's where this 592 is coming from. But this was really not a losing trade. It was a profitable trade. And so I just wanted to show how to manage those types of trades. And if the market really tanks over the next 2 days, it's possible that Oracle, this $48 put here, will have a value. And so some option traders might put an order on this just to try to sell it for like 5 cents or something like that. Remember that selling a single position is going to have a transaction cost associated with it. So you have to make sure that what you're selling it for is going to cover the commission or the transaction cost. So, but a lot of people will just leave that on there. Most likely going to expire worthless if it's above $48 on expiration, or if this stock is above $48 on expiration, then it's going to be out of the money and expire worthless. But yeah, who knows? Something crazy could happen over the next 2 days, and this option could be worth something. Okay, so that's what I wanted to start off with, is talking about just managing the verticals. Our class title today is options with a focus on vertical spreads, and we've done that. One of the other things I did want to do today is to talk about our inventory trading that we've been doing. I haven't been here on Wednesdays for a couple of times, and so our inventory positions that we've had here on SPX, we have one expiring today, just barely out of the money with a little bit of a pullback that we're seeing. 0 days till expiration. This does expire today. We're $2 out of the money, and this thing is still trading at $1.80. Now, again, we could see the market pull back another 2 points very easily here. So a lot of option traders at this point, rather than risk this going down any farther before the day is over, might just close this down. A couple days ago, obviously this was a little bit better yesterday than it is today because we're down 18 points. And so some traders will close these down within, again, a couple of days of expiration. But I do want to go ahead and close this one. We're going to right click, create a closing order, and just buy that back to get out of that obligation there. We're getting some mid and nat quotes here. We'll try to split the difference a little bit at $1.40. We'll send this order off, see if we can get filled. Remember, there's a transaction cost here as well. So that order's in there working. And even here in the paper money account, it's having trouble getting filled. Now, again, one of the reasons for that is when we get close to expiration like this, you start to see some kind of crazy activity sometimes. These spreads are really pretty good at 30 and 40 cents. These aren't too bad, but these are getting pretty close to expiration. We're literally an hour away or 40 minutes away from the market closing, and so these spreads do get a little bit kind of crazy sometimes. And if you're looking at this trade, it's quoting at $1.62. Our order was to get out at $1.40, so this actually has to quote quite a bit lower. Now, if you really want to get out of this type of position because it's pulling back a little bit, or just because you want to take the profit that you have to negotiate a little bit, and we set it off as a $1.40 limit, not filling. It's just sitting there. So if you wanted to change that, and this is getting a little crazy, we see the market's dropping, and this spread's becoming more and more expensive, $2.30 now. And so we're almost $1 above the limit where we were a few minutes ago. So if you want to try to get out of this more quickly, you can put the order higher. Anything below 540 would be a little bit of a profit, but this is one that we rolled out of. If you remember, several weeks ago, we rolled into this position on something that was in the money, and so we collected a little bit of a credit here, I believe, maybe some debit, and it is a profitable position. But these numbers are, if you watch the SPX verticals often enough, or these quotes, these do get kind of ridiculous. They're up and down, and I mean, even here talking about them, they've moved from 230 or 220 back down to 180. Our 140 strike is still there. The market's back only down 18 points, where it was down 19 and change a little bit ago. So we could leave that order there sitting and see if it starts to fill. We will be here until the close, so let's go ahead and leave this order at 140 just to see what happens. Okay. Now we could also look at this one here, the 2640 put spread. If you wanted to, 7 days left on this one, 35 cents. Buying it back for about 32 cents, or 0.2 times the original credit, would give us about 80% of the max gain. This is getting really close to there. You could set an order to close this down at, say, 30 cents or so. And let's go ahead and do that, and we'll kind of start this inventory trading over again. So there's a 30-cent debit. We'll leave that in there. This one will make good till canceled. Let's go ahead and make it 35 cents, see if we can get filled right away. Remember the transaction cost there. And again, the SPX options, okay, so we just got filled on the 21 March. So that was the one that expires in 7 days. So we took the profit on that one, and we'll see if this order fills at $1.40. The market's probably going to have to go up 4 or 5 points for that to happen. All right, so I've kind of covered the first part of our session today, where I wanted to talk about our long verticals, managing our long verticals and managing our short verticals. And like I said, if you go back to that active trader page on the Thinkorswim or on the TD Ameritrade site, if you go to this one here, go find the 21st of February, okay, and the title is Using Option Strategies to Help Protect an Individual Stock or Entire Portfolio. And we spent most of this session on the 21st talking about individual stocks, covered calls and callers. And toward the end of this session, I started talking about what's called a short put vertical strategy, where we were doing the protection on the whole portfolio. And so I did get some feedback that we wanted to have a little more in-depth discussion about that, and so I've chosen to do that today. And so let's go back over here and talk about this concept. Now, it is a little advanced here, so I'm going to try to slow down and talk about the little different concepts that we're doing, and we're going to just manage a section or a group of our portfolio here together. Okay, so what I want to do is, I have some stock positions here. I have Apple, Amazon, Boeing, FCX, Gilead, Micron, Nvidia, and United Healthcare. You can see some of these just have the shares listed. The ones that do not have the shares listed actually have a covered call. And you can kind of see that over here. You can see that we have 100 delta on our Apple position. We did place a covered call on Apple I think it was a week or two ago. And the stock, or Apple, broke resistance, went above that 180 and stopped us out, and now here we are back down below 180. And if we had not had that exit order, the covered call would still be protecting this position. But as of right now, we ended up taking a loss on the covered call I placed, and now the stock's back down below the resistance of 180. So, there are advantages and disadvantages to really everything you do in the market. But you can see these other positions. We have a 21 net delta, 84 net delta, 351 net delta, 600. Now it has a round number and no theta. So you can pretty much assume here that there's no option trade if there's no other Greeks other than just delta. And then, of course, we have the MU position with 77 delta, NVIDIA here with 37 delta, and we have our United Healthcare with 100. And if you added all of those deltas up, you have a net delta of 1,373. Now, so let's start this conversation. Again, our objective over here in the next 35 minutes is to talk about this idea of protection. Now, you can always protect your individual positions. Well, maybe not use the term always. You can use a protection strategy called a covered call or a protective put, or you can combine those two, and when you sell a call and buy a put, they refer to that as a caller when you own the underlying asset or the underlying stock. All right. Now, in the case of ours that we just did on Apple, using an exit strategy, we took a loss on a covered call on our Apple position. And so some people like to, rather than sell a covered call on an individual position, rather than buy a protective put on an individual position, or rather than do a caller on an individual position, some individuals like to use what we call a portfolio protection strategy, and the very first part of that is to try to get your Apples, Amazons, Boeings, and everything else to match some sort of index. Now, I've got several, what I would consider S&P 500 stocks in here. We have several NASDAQ stocks in here. We even have a couple Dow components in here. So the index that you use really could be just about any of those major indexes that best represent your portfolio. The S&P 500 is a very common one that people use, and if you're doing it on the index, then that's a that's a broad index that we could use to hedge our part of the portfolio. So Ricardo brings up the point here that 1373 is kind of meaningless unless we actually compare it to something else. And some investors do look at that exactly that way, Ricardo. Others do not. Others say, others have rules associated with just their net delta as a percentage of the account value. And so some of these things are possible. But what we're going to try to do is called beta weighting. We're going to try to change all of these deltas that we have here and change them into an index delta, and we're going to use SPX. So what I want you to do is look at this delta number here that says 1377. I'm going to click beta weighting up here, and this is on the position statement line. If I click beta weighting, and I've already got the SPX in here, you can see that the delta's now changed from 1300, right? 1300 individual little pieces. I kind of think of this as a fruit basket. We have apples and oranges and pears and bananas and all these different things, and we're trying to create a fruit like the SPX. Let's just call it a kiwi. We're trying to create all of these little fruits here in our portfolio and say, well, how many delta of apple is actually the SPX delta here for what we're calling a kiwi fruit, all right? And so you can kind of see, if I uncheck the beta weight again, you can see we go from this 1376. If I click the beta weighting, now we've translated all of those deltas into a net SPX delta that in this case is totaling about 82 points. And so theoretically, now what this means is when we beta weight a portfolio, theoretically, if the S&P was to go down $1 or down 1 point, we would lose about $82 in our portfolio. Now let's see kind of how close we are. Let's go take a look at the chart. How far is SPX down right now? SPX is down about 18, let's say. And if we took 18 times 82, so 18 times 82, that would give us a loss amount of about 1,476. And so our P&L for the day right now is down 1,200. So it's pretty close. It's not 100% accurate when we're talking about, you know, this idea of beta weighting. Okay, part of that might be due to some of the covered calls that we have. Some of it might be due to just fluctuation in price. Some of it might be due to rounding. You know, we're rounding our SPX deltas here into a 2-digit number, and so there might be some rounding differences, etc. Okay, but that's what that means. Okay, is that we're trying to translate our deltas into an index delta here at 82, and that's the first step. All right. Now the second step is to decide how much of your portfolio it is you want to protect. All right. Does that make sense? So if we're translating this into 82 SPX deltas that we have in our little sample example portfolio of stocks, that some of which have covered calls, some do not, we have 82 delta. Now one of the first questions would be well, how much of this do I want to hedge? Now, some option traders are like, well, I don't like this down 1,000 at all. I wish we were hedged 100%. And so some traders will go to these extremes, right? They'll try to hedge off the whole portfolio by creating negative 82 SPX delta in a trade, and that's what we're going to try to do here, is create a position that you know, we're going to create some negative SPX delta that theoretically would help hedge a continued drop in the value of the S&P 500. Okay, because a lot of our stocks here are pretty much correlated, right? You know, Amazon's up today, FCX is up today, and MU is kind of flat, but everything else is down, and so the market is a market of stocks, and so these stocks, I believe every single one of these, if I remember right, is in the S&P 500. So when the S&P 500 goes down, about 70 to 80% of the stocks in the market that make up that index are probably going down also, right? Usually not 100% of them, but you know, here we have a pretty good example where we have what, about 8 positions, 1, 2, 3, 4, 5, 6, 7, 8. 8 of them are in there, 3 are up for the day, 5 are down for the day, and so 5 divided by 8, that's 62%. 62% of our small sample portfolio here is going down. One's pretty flat, and the other 2 are up. So again, when people decide how much of their portfolio they're going to hedge, a very common number is about 30 to 40%. So you'll have to decide on your own rules. But for our paper money account, let's go ahead and use 40%. We're going to hedge 40% of our 82 SPX delta. So what do we do with that? Well, we're going to take 82 times 0.4. Okay, let's use 83 because that's a little, we're rounding up to the, well, it's going to be changing, but let's use 83 times 0.4. Okay, if you do 83 times 0.4, you should get 33.2 is the number. So we want to hedge 33.2 delta. Okay, and so this is where we're going here. And Gordon's asking about the beta weighted delta. Does this mean your chances of success are 18%? You know, delta, if we're looking at delta on the option chain, we can look at delta as a probability approximation. When we're doing it like this, success, you know, number one, chance of success, what does that mean? Well, I mean, it means a lot of different things to a lot of different people. So you would not interpret this delta here as that. This delta, the best way to look at this delta is just look at it as directional risk. It's positive, and if the S&P goes up, then generally speaking, this portfolio would go up. Okay? And again, theoretically, if the SPX went up 1 point, our beta-weighted portfolio would be up about $1, or sorry, $82. If the S&P went down a point, then we'd lose $82 theoretically, and we're pretty close. We calculated at an 82 SPX delta with the SPX down about 18 points. This would be down about 1,400, and here we are sitting down about 1,200. So it's pretty close, but most option traders and beta weighting enthusiast would not look at this as a chance of success. It's just simply directional risk. Okay, and that's a much better way to look at any delta on your monitor page, especially if it's a stock position, because stocks don't expire like options do, right? Options individually have that probability of being in or out of the money, which is how you're interpreting delta, and that's not really what this delta says. Okay, so we've calculated again our beta weighted portfolio. We've translated all of our delta into SPX delta over here, and we decided, I decided in a class, and again, this is just not a recommendation, it's just a guideline. We're going to hedge 40% of this, and if we take 0.4 times 83, we get 3320. And so what we're trying to do here is we're trying to create a position in the index that we're using for our beta weighting to get 33 delta. So how do we do that? Well, the best way to do that is probably on the Analyze tab. Just go over here to the Analyze tab, click on the little symbol box over here, and we're going to be in Add Simulated Trades. So click on Add Simulated Trades and type in SPX here, and then it's going to pull up the option chain just like it does on the trade page. Now, one of the things that's interesting about protection is how long do you want to have the protection? And remember that the longer you go out, then generally the more expensive that protection potentially becomes. Now, we're going to be using a short put vertical strategy, which adds a level of complexity to this concept here. If we just bought a put option, then I think that's probably the beginning level, which really isn't beginning. That's still pretty advanced, but we're taking a long option, and getting our head around a long option seems a little bit easier because those things are a little bit more intuitive. But if we use a short call vertical, we're going to use our Analyze tab. We're going to use the Add Simulated Trades. We're going to look at the risk profile as well. But what we're going to focus on is the Greeks of this position that we create. All right? And again, as a general rule of thumb, you might ask yourself by going back to the chart, well, how long do I want to have this protection on? Do I want to have the protection on for a few weeks? Or do I want to have the protection on for a few months or somewhere in between? And again, there's really not a right or wrong answer there. A general guideline, again, for these types of selling strategies, just like we do with our put verticals and call verticals, is be out in that 20 to 50 day range. Now, one of the things you want to remember with the SPX is that we have expirations on Monday, Wednesday, Friday, and then occasionally even on Thursday. So every day of the week except for Tuesday, these options are expiring, and that gets real confusing as well with the SPX options. But I'm going to do this. I'm just going to come out here. We're going to go out about let's go out 30 days. We have a 13 April expiration, and I don't remember what day of the week that is. It doesn't really matter per se, but you do want to remember the 13th of April. These options are going to expire, and they have the same risks associated with them that they would with any other short call vertical or bearish type of trade. And you could do like a long put vertical, or you could do a short call vertical. Those are both bearish trades, or you could buy the put. We're going to focus here today on selling a short call vertical. So we're going to kind of go through this step by steps because it's just going to be, there's so many little moving pieces here, and I'll go through it again after we're done doing this to kind of start to finish, okay? So the very first thing is you're going to have to change your strikes to get into like a delta of 30 to 40-ish delta. You're going to have to go pretty far out of the money because there's quite a few strike prices available. So type in here maybe 35 strikes. And then we're going to change our column here to delta. All right, so there's a 30 delta. Again, there isn't really any right or wrong delta. Just remember that call sellers and put sellers, and we need to be on the call side, I just remembered. But 30 to 40 delta is pretty common. So we're going to look at a short call vertical, and we're going to look between a 30 and 40 delta, and so we have quite a few choices. Look at this. We have 1, 2, 3, 4, 5, 6 strike prices that fall within that 30 to 40 delta range. And so we could sell a 27.75 call spread, or we could sell a 2800 call spread. Now, let's start off with that. I'm going to go in here with the 40 delta just to show you a couple things, and we'll talk about a couple different strike prices. But to create a short call vertical, how do I do that? Well, I'm going to do a right click. I'm going to analyze a sell trade, and we're going to sell a vertical. Okay, and now I click that. Now where is it? Well, it's kind of buried. So usually what people will do is they're going to move their price slices up a bit. Okay, and I'm going to keep this line up where we can see the blue one. And then we have what we call positions and simulated trades. Now the problem is we have some positions on SPX that just got closed, so those are kind of in the way. Or if you had an open position on SPX and just wanted to see this new simulated position we're talking about, right here where it says show all, you want to click that and change it to hide positions. And so what that does is if you have any open positions currently on SPX or NDX or DJX or whatever you're using here for your hedging, is this will hide the real positions and it looks at just the simulated one you just created. Now, I always like to move that down to one contract so I can kind of see with just one contract what the Greeks are and get an idea. All right, so here we are looking at a trade where we sell a 27.75 call and we're buying a 27.80 call. All right, and so the market right now is at 27.46. Now, the very first thing you want to remember is what? If the market gets above 27.75, these are going to start to be in the money. And what does an in the money short call have with it? Well, now we have assignment risk, right? And we don't own the underlying here. We own a lot of stocks that we created to try to create this XPX delta that we have on our beta weighting. So this is in and of itself just a standalone short call vertical that has the same risks associated with it that it always does. If it expires in the money, then you're going to have an assignment risk. If it's above 27.80 on expiration, then you're going to have a max loss. And what is the max loss on a vertical? Well, it's going to be the spread, 5 points, minus whatever the credit. So if we got a 225 credit, then we would have, let's go ahead and lock that in there at 225. The max loss is 275. Okay, so that's kind of the vertical review. Now, more importantly here, again, we're trying to hedge our portfolio. And again, I'm going to walk through all these steps again as we kind of finish up when we're ready to do this trades. We'll walk through them before we send this order off. All right. Now, what I'm curious to know mostly is, well, how much negative delta or how much bearish delta does this create? And that's where we go up here to our zero line. Do you see right here? This is our active quote. This is our last trade, and this zero line, the one in the middle on this price slice, is reflecting our current Greeks for this one contract. And you can see we have -2 delta. We have positive 1.8 theta, and that means that, the value of this spread would decline each day by the theta amount. We have negative vega, so if volatility goes down, that's a negative times a negative, and then we have positive vega affecting our trade, and that's bad for this trade. Volatility going increasing is kind of the wrong way. So it'll keep those option values semi-inflated, and it would take longer and longer for this to decay over time, okay, with volatility moving. But I'm not really concerned so much with theta and vega on this trade. I want to look at the delta. Now, if you remember, how much delta did we have? Well, we had an 82 delta, right? We had 82 net beta-weighted SPX delta for our small little sample portfolio of stocks and covered calls and things, and we wanted to try to hedge 80% of that, and we wanted to create a delta of -33.2 to create that hedge. So now this is pretty easy, just math. Well, this one contract creates delta of -2, and if I take 33 divided by 2, I need to do 16.5 contracts. Let's just do it 16. Now watch my delta here change. When I hit enter, now I have 34 delta. Now again, this starts to come into rounding a little bit, and the price of the market has changed. Look at this, we're down almost 20 points now. the price of the market has changed, so the numbers are moving around. But we could say, well, let's just move that down to, say, 15. Well, there we go. We're pretty close to 33. So it looks like, okay, it looks like we have to sell 15 of these call spreads to hedge off our 33 or our net 82 to 83 delta that we had when we beta weighted. And so from here, I could just simply right-click on the order and then send it off and review and do a confirm and send. But before I do that, I want to kind of go back through the steps from start to finish, okay? All right. So let's go back over here to the Monitor tab, and let's go back to the very beginning where we're going to unbeta weight. And we have, again, our little sample portfolio that has 1,397 delta. And we're saying to ourselves, well, I don't want to do a covered call or a protective put or a caller on every single one of these positions. I want to have an index that I can use to hedge off the market pulling back, and I want to hedge about 40% of my portfolio. Okay, so step number one is to do what's called beta weighting. We're going to click over here on the beta weight up on the position statement line. We're going to pick an index that best represents our portfolio here. We just chose SPX. We probably could have used NDX as well over here, but SPX. And so we have an 82 beta weighted or 83 beta weighted delta, and we decided, well, we're going to hedge a percentage of this. Again, you have to pick the percentage, but we're going to hedge in this example about 40% theoretically, and we're going to multiply 0.4 times 83. So 83 times 0.4 equals 33.2. Then we decided to jump over to the Analyze tab. We went down here to the Add Simulated Trades. We clicked in our index that we're using to beta weight our portfolio, and SPX is our choice. We opened up the option chain, and we decided, well, as a general rule, people go out about 20 to 50 days. We just picked a generic 30-day expiration, so we'll have the protection for 30 days. After 31 days, these options won't be protecting anymore because they're going to expire. We opened up the option chain. We changed one of our columns here to delta. We also changed our strike prices out to 35 so we could see more of the inventory that's available. And then we just scrolled down and tried to find a delta between about 30 and 40, and we started with around the 40 delta and came up with 27.75. Okay, and then we did one contract to start. We did a right click on that. We did an Analyze Sell Trade. We clicked vertical, and then that created this simulated trade. We jumped over here to where it says Show All, and we didn't want to see our open or active positions. We just want to see our simulated positions, so we're going to hide the real positions, and we're just looking at the individual piece here. And when you put a check mark in it, then it shows the Greeks. Okay, and so we decided, well, I have a -2 delta associated with each contract. And again, we wanted to get 33 negative delta, so we simply took 33.2 divided by, 2.19, I guess would be the best way to do that. And that gave us 15 contracts, and we changed our contracts to 15. We kind of double check our net delta here at 32, and now we have this credit at 235 right this second, and we could send this order off and get filled. Now, before the market closes, I do want to get this order off. So in the next 12 minutes, I want to show you a couple alternatives here, okay? So remember this delta. We're about 33 delta here. Now, what's going to happen if we have 15 contracts? Well, 15 contracts is going to be a pretty big transaction cost, right? We're going to have a lot of contracts. If we hit confirm and send, I mean, we're going to have to pay, in the paper money account, $51 in transaction costs to do these 30 total contracts. Okay, and we have a max loss of 4,000 and a max profit of about 3,400, which the idea here, of course, is it's trying to hedge off some of the market dropping. Okay, now a couple real important points here before I talk about how to maybe reduce our transaction cost. Okay, now this is really advanced stuff on options, but I know some of you in the class know this, and you get a gold star if you can answer it. What will happen to this delta if the market drops? Okay, this is a very, very advanced option Greek philosophy or study. This is a call spread. what will happen to the delta here as the market goes down? This is really important. Okay, now I know some of you are probably thinking about that, but here's the answer. This is a call spread. As the stock market goes down, these are going to get farther out of the money. Farther out of the money options have lower and lower and lower deltas, and so the net delta here is going to get lower and lower and lower. Why is that important? Well, because we want 33 delta to hedge our position, and if the market goes down when we actually need the position to be protecting us more and more, this protection actually starting to become less and less because the delta gets smaller. So using this type of strategy, some traders might want to say, well, I'm concerned about the market going down. I understand that the net effect of the market going down on this short call vertical trade is that the deltas will get smaller. So maybe I want to start off with a bigger hedge, which is actually one of the reasons I started with 40% rather than say the low end at 30%, is because that gives us a little bit of that wiggle room. Does that make sense? So let me say that again. The short call vertical delta will decrease down to 0 if the market drops farther and farther because these options become farther and farther out of the money. Now a put option is just the opposite. If I buy a put option for protection, if I scroll this up, let's say we wanted to buy a put. So I'm going to go ahead and click this put in here. If we did one put, now let me uncheck this. Look at this. Well, let's do it even this way. Okay, let's delete that altogether. Let's come out here and look for a 33-ish delta. Okay, we wanted 33 delta right here. Okay, so I'm going to buy one put at $27.05, and it's going to cost me $2,590 to do that. What happens to put deltas? Okay, here's our delta profile up here because I have a check mark. You see that? If I check that one, 33 delta, that's exactly what we needed. And so we could use this as a strategy to protect our portfolios. We could just buy a put, but that's kind of outside the scope of our vertical class today. But here I just want to do a comparison. 33 delta, almost identical, right? If we check the vertical and uncheck that, now we have 33 delta again. Okay, so these are very similar delta profiles, but the difference is, first off, is that what happens to put deltas? If the stock were to go down, what will this put delta do? Well, you can kind of see the closer we get to the money, right, the deltas increase. So a put option like this actually offers more continuous protection per se because the deltas increase as the stock starts to go down. Where the call spread here, the net delta decreases because those calls get farther out of the money. Okay, so this is an important comparison when you're looking at this overall idea of protection. Okay. Now, another big difference is this. Well, that's going to cost $2,500. Now, what do we know about a long option? Well, what do you see right here? See this theta? This is what scares people away a lot of times on these long options is there's negative theta. Pretty big negative theta. And if the market does go down, but it goes down very slowly, this is at 27.05. It's still 43 points out of the money. Theoretically, if this goes down 43 points, but it takes all the way till 13 April to do that, this option is going to be worthless if the stock market's above 27.05. So that was $2,500 of protection that ultimately ended up going out the window, right? So these are some things just to realize here. Let's go back to our vertical trade. I'm going to leave that one on there just as that comparison. But I just want you to realize that if the market does drop, the short call vertical protection becomes lower and lower, and so what you have to have as a strategy here if you want to try to maintain that delta is to have little periodic evaluations. How far has the market dropped? Is this call vertical now worthless essentially where the delta is really not protecting me anymore, and maybe you buy this call spread back for a gain and then put another call spread on as protection. Okay. The other disadvantage of the vertical, of course, is the transaction cost. And if we do try to compare it kind of apples to apples, if I do a right click on the vertical, the max loss is $4,000. What was the max loss on that put? Well, if we buy it for 2,500, the max loss is 2,500, right? So the difference being is that if the market goes up, then our position that we're trying to hedge will generally increase in value, right? And so it will offset some of the loss perhaps we're taking on the call spread. So there's a lot of moving parts on here, and I just wanted to talk about those things here before we send this order off. Okay, but let me go ahead and get this order off, because what I want you to see is, on the monitor tab here we have 82.6 delta. I'm going to add in that spread into this group, and then we're going to take a look at where our net delta is afterward. So let's go to the Analyze tab. Here's our trade. We do a right click on it. We're going to do a confirm and send, and let's do it this way. I just want to make sure it fills here while we got 5 minutes left. I'm going to put this price, I'm just going to make this price a $2 credit right now, just because that's lower than the current quote, and see if we can get filled right away. So confirm and send. Remember your high transaction costs. We have 30 contracts. We're going to send this into our covered call group. We have 82 beta weighted delta. We're going to send this off. Okay, we just got filled at 230, so that's about where the mid price was. Now, what do you expect our new delta profile to be? What should it be? Okay, what should it be? Okay, we had 80. We created a negative 33-ish, so we should be in there where? Where should we be in there? About 50-ish, right? Let's go see. Monitor trade, there it is. 50 net delta, 33 delta attached to our SPX trade. And if the market continues to go down, then this will hedge off our loss. It'll still be a loss, right? Because we still have net positive delta, but we did pick up a little bit of theta here with this position, and we did collect a credit, right? Now, if the market is below 27.75, then we're going to be able to keep about $3,000 of profit here, hopefully offsetting some of the loss that we're experiencing in this part of the portfolio. But here we are again. If the market rallies, this does have a potential loss of about $4,000. Okay? And so if you were more bearish on the market, or if you're concerned about the market coming down, which it is over the last couple of days, we got a little bounce off horizontal resistance, and we're coming kind of really close into the diagonal resistance that was broken on the 9th. So we may see it just test here and then go back up. And if that happens, if it kind of re-breaks this 29.90 or 27.90 range, some people would take the protection off and try to avoid the max loss. So you know, you have different ways to manage that trade. But here we are sitting at 27.75. The market can go up about 30 points here before this starts getting in the money. And if it is in the money on expiration, then you're going to have an assignment risk, and you have the risk of losing that max loss, which is about $4,000 on 15 contracts. Okay, so hopefully that was helpful for you, going over these different things. Just kind of a quick recap of what we did today. We closed out our SPX inventory. We don't have time to put some more inventory on, so we'll try to do that either later in the week or next week. We talked about managing a long vertical. We talked about managing a short vertical for a win. And then we talked about beta weighting our section of the portfolio here, trying to change these deltas into SPX deltas. And then we walked through the process of calculating how much hedge to create, how to analyze those different positions there, and then how to create a trade that equals those deltas, and talked about some of the ins and outs of doing that, right? Now, one last thing here in the last couple minutes. We could have done it this way. Let me go back to the Analyze tab, because I want to show you this again. Let's go over here, and we did the 40 delta, so I'm going to do a right click, Analyze, Sell, Trade, Vertical, and we knew we needed 15 contracts, but I just want to do a quick comparison. I'm going to delete this line here. Check this out. What if we duplicate this order? We're going to do a right click and duplicate it. So that, oops, I want to analyze that, not that. Okay, so let's go back over here to Analyze. We're going to do a right click, Analyze Trade. So we're going to just create another one of those. What if I wanted to do this? Now keep an eye on the deltas again. Okay, so we know we have 33 delta with 15 contracts, but 15 contracts was rather expensive. What if we make this 10 points wide? Okay, let's go 10 points wide. 27.85 right there. Now we're getting a bigger credit, and now we have 65 delta with 15. I can probably get away with 7 contracts, maybe 8. And there's my 33-ish delta, little bit bigger credit. Confirm and send that. I still have about the same max gain, max loss, but my transaction cost now is a little bit lower. And so you could do, wider spreads and then create a little bit less commissions here and end up with about the same type of delta. All right, so hopefully that's helpful for you. Again, remember that all the things we've talked about today are for educational purposes, not a recommendation or endorsement of any strategy. All investing involves risk, and past performance of any security or strategy does not guarantee future results. And be aware that any trade you make in your self-directed account is solely your responsibility. Thanks for being here today. Remember that you can place a trade, and what I'd like to really see you do in your paper money accounts is practice some of these strategies that we've talked about today. Either put on some long verticals or maybe do a paper money hedge of your positions. All right, so have a great day, everyone. We'll see you next time, and look forward to maybe seeing you tonight in our session. Thanks, everyone. Bye.